Thank you very much, David, and good morning, everybody. Happy New Year. As David said, I'll try and give you a bit of flavour of the gas scene in Africa, Southern Africa, East Africa, and focus on gas and how it fits into global liquefied natural gas, i.e. is there a market for it? Does it make sense? If anybody finds more gas from here on in, is there going to be space in the market for it? So, without further ado, the key thing we have to look at is gas prices. You know, gas prices need to be sufficiently high to attract new gas molecules from whichever region that we're talking about. So it's illustrative to here to just remember what has been happening to gas prices over the last 5-10 years, and also out over the next 5 years. If we look at 2005 up to 2010, whether you're in the UK or the US or Europe or Asia, prices were pretty much linked together and moving in the same direction. And it didn't really matter where you could send your gas, you're going to get a similar gas price. As you all know, or you may know, since the global recession, the divergence in global gas prices has been very wide and very, very stark, causing redirection of global gas flows in the last couple of years. And the biggest prices are in Asia, which is depicted by this blue line here. This is a Japanese LNG import price. These black lines are continental European prices. This green line is UK gas prices, and then you have US gas prices down here. So naturally, everybody's looking at the blue line and wanting to set up a business that sends natural gas into those markets. But these markets are still quite healthy here in Europe and the UK. You know, $12, $13 per MCF is still a very attractive gas price. So there are still a number of markets available to be sending liquefied natural gas. So that's the first big driver. That's important. So we're starting off on a good foot forward. Second thing is, excuse me, what about demand? So you have to, prices might be okay, they're kind of linked in contracts or linked to oil prices, but is there demand for cargoes to come in? And if you just take a step backwards and look at LNG demand, again, you're going to walk away with a very comfortable picture of the world, in that LNG demand from 1998 up to 2012 has really grown at 5-6% per year. And it's always dangerous to extrapolate up in this type of fashion here as I have, but it has been the trend that we've witnessed over the last 10 years. We expect more of the same right out to 2020 for LNG demand. So that's a good 6% increase in demand every single year from here to 2020. That's obviously double global natural gas demand. So LNG is double the gas demand, and then oil demand, you remember, it's probably about 1% per year. So this is still a very niche little commodity subsection that's particularly attractive. As you can also see, it's all about Asia Pacific at the moment, dominating the imports of LNG, and then you're getting that double whammy of the nice pricing as well, and that just really emphasizes how attractive that part of the world actually is. Just to zoom in here and understand who is it in Asia that's pulling in all this LNG, and will they continue then? You can break it down by country, and the colors telling you Japan, Korea, China, Taiwan, India. And again, you can see Japan and Korea, who are the two largest LNG importers globally, are the dominant breakdown of that Asian number. So they are big importers. They stepped it up in 2011 and 12, as you can imagine, after the Fukushima tsunami, where you see these 10-20% annual growth rates of LNG imports. So we're still seeing reasonably strong strength here on the back of those countries, but also on the back of that particular event back in 2011. And we don't really expect this to change markedly over the next decade. What is interesting, though, is that there are new emerging countries in Asia which will want increasingly to find more LNG. If you simply look at our little container tanks here depicted on the east coast of China, you know, there's another 7 or 8 import terminals for LNG being constructed along the coast of China to bring in LNG. So China's big in oil and big in coal and big in iron ore, but it's not a big importer of LNG. That is going to change. As you can see from this chart, we expect it to really double. Well, really from 20 million tons of imports annually to about 30 30 or just over 30 by, sorry, not doubling, but up to 30 by 2015, and continued growth after that. So that's going to be a big story in the next couple of years, and you're going to see a lot of gas going into that region. The other area is India as well. As I'm sure many of you know, the sort of Krishna Godavari Basin hasn't really delivered the big domestic growth supply that was anticipated in India. So they too have demand outstripping supply, and therefore are building lots of LNG import terminals all around the country. And again, that will lead on our estimates to a step up in LNG imports as well. So two other big regions in Asia set to become large importers of LNG. So already we're setting ourselves up for a very attractive LNG market for anybody who has gas in Africa. And also, just to show you that it's not simply about China and India, you can just take a look at some of the other countries down here. Some of them may be a bit surprising. You know, Argentina and Brazil are going to start importing a lot more. Even Kuwait, which is always the one I find interesting, they import their LNG from Russia and not from their neighbors. But a lot of these Middle East countries, UAE as well, set to increase their imports of LNG as well. So it's really happening everywhere. And no matter which, Singapore next year and other parts of smaller countries in Asia, all starting to become net importers of natural gas. So it's I think it's a well founded part of the energy sector in terms of LNG. Okay, so that's a bit about demand and pricing. The next thing you need to tackle is supply. So is supply about to ramp up strongly and therefore hurt pricing and actually offset demand, that the market becomes very soft and unattractive to sanctioning new projects which may be located in southern Africa. This is just giving you a bit of granularity on global LNG supply. The black line here is just monthly, year-over-year growth in LNG supply globally, and you can just take a look at it and see it comes in waves, and there's tranches of growth and then it fizzles out. And then you get another period of growth. This last period of growth, 09, 10, 11, was the Middle East, primarily Yemen and Qatar, coming on very strongly. 20% annual increases in LNG exports into the market, created a bit of softness and a little bit of pressure on prices at that point. But as you can see, through 2011, 2012, we're getting beyond that. That growth is in the market, demand is still growing, and we're not seeing any further LNG supply come into the market. So again, another positive when we're thinking about this particular space. So what does that, when you put all that together, what does that mean for a snapshot of the market today? This is one way to do that. It's called spare capacity. So you take demand, you take off supply, how much are you left over with? Are you left in a surplus, which are these green bars? And then you plot it as a percentage of demand in the black line, and you see that period of 09, 010, when the Middle East was ramping up new LNG supply, we were up at about 20% of demand available in spare LNG capacity. So not the ideal conditions to be kicking off with multi-billion-dollar investments. However, 2012, 13, 14, 15, given everything that's being built, given that demand number, given the supply kind of drifting downwards, given the forecast we can see for new projects, we do expect it to kind of continue to decrease. So the fundamentals look attractive. And ultimately, if we don't build any more, we're going to end up in a horrible situation here in the back end of the decade with real shortages of LNG, and therefore extremely high prices and kind of super profits available for anybody who has LNG. Okay, so that's all setting itself up nicely for African LNG. However, there's a kink in the story in that North America has just a massive amount of cheap natural gas, and therefore, being the entrepreneurial region that it is, and 28,000 companies all trying to get some way to get their gas out of the region, we have 20 projects on the table in North America trying to bring gas out of that continent. That's 20 projects here. You add them all up and it comes to very big numbers, like, in the US, 26.5 billion cubic feet per day of exports. That's like 40% of their current consumption. Clearly, that's the debate the government's having. How much do we let out, because you leak out 40% of your volumes, your domestic price is going to skyrocket again. So this is the question mark that we have in 13. How many of these is the US administration going to sanction? We have an assumption, so there's 162 million tons here, and we put in about a third of that into our assumptions going forward in terms of exiting that particular region. We don't think all of this will happen for those reasons because of the utility lobby, the chemical lobby, etc., etc. And just to amplify how good that resource is, you can add up all the volumes here on the x-axis, and you can work out the cost of production of all of the shale, all of that cheap gas within the US. And what you realize is that, you may know that US gas prices are about $3.5 per MCF. There's a lot of gas. There's 300 trillion cubic feet available at that gas price. So it's and the US consumes 20 TCF per year. So there's 5 years, 10, 15, 20 years of supply available at today's gas prices. So there's a lot of it, which is different than actual shale oil. And then what that means is that you can produce it here at very low cost, $4. You have to turn it into liquid form down to minus 160 degrees Celsius, and therefore that costs another, another couple of dollars to do that. But whatever your full cost is, it still makes sense versus this LNG price and your delivery cost from the US to Asia, Europe, or the Americas. You still have this margin. The difference between that and any of these is an attractive profit margin for any company to be pursuing, and that's why you have that list of 20 companies on the prior slide. So things are definitely moving very, very quickly here. So there's a lot of gas in the US. The dynamics are positive for LNG. What else is happening before we just focus on Africa? Well, if we look at conventional discoveries of oil and gas globally, and just look at the last 3 years, 10, 11, 12, it's staggering how much gas we've been finding globally. 40% was gas in 2010, 60% 2011, over 70% last year of global conventional oil and gas discoveries turned out to be natural gas. So there's a lot of it around, and they'll all be looking at those same dynamics that we just discussed. If we plot it in terms of offshore discoveries as well, and water depth here on the y-axis and time here, and just plot the gases as blue, or light blue, then you just see those last 3 years here, just how much gas we're finding, and all ranges of water depths. There's just a lot of gas being discovered today. So into East Africa, Southern Africa and East Africa, and let's analyze that situation. As David mentioned at the beginning, very little appetite and people writing off East Africa through the decades. And I love looking at these little wildcat maps. This is 1965 up to 2005, looking at Africa, seeing all the predominant drilling in the north and Nigeria down to Angola, and very little elsewhere. And zooming in here on Tanzania, Mozambique, some shallow water onshore drilling here in Tanzania, but nothing really happening between the countries or deep water. So it's, that kind of proves the point that David made at the beginning. Now if we look at just the last, this is just since 2010, we're seeing, obviously you can see the increased drilling here in Uganda that Tullow were doing, but also if we zoom in again on Tanzania, Mozambique, across this particular basin and the deep water, you're seeing the increased number of wells that have been drilled, and we know that they've been successful, which we're going to discuss in a second. But people still drill in the old regions, as you can see here and here, but this region definitely starting to kick off. So again, when we go back to our bubble map and just replot natural gas in terms of East African gas, then again it's just illustrative to see that chart again and see how much of the last 3 years has been East African gas. And the size of those circles depicting the volumes as well, it's in correspondence to the volume size. So we're talking about big billion barrel oil equivalent size discoveries over the last 3 years. So it's all quite impressive. And then if we add up all the volumes globally over the last 3 years and rank it, again, you've got Brazil obviously still hitting number 1, Mozambique coming in number 2, and then number 6 or 7 here, Tanzania coming in as well. But so combined across that Rovuma Basin, 17 billion barrels oil equivalent have been discovered. Just a monster number. But I mean, other countries here is a lot of gas. Israel, we know, is all gas. Azerbaijan was a lot of gas. Australia's gas. Cyprus is gas, etc., etc. So all of these regions also trying to monetize their gas within the LNG market. So what about Africa, and is there space for more African opportunities which are in gas to be exported and people to make a healthy return? Well, it's useful to look at existing African exports of LNG because they're actually declining. A slow decline here. We look at the key exporters of LNG in Africa, all of the countries you can see here, the big 5. But generally over the last few years, there's a slow, steady decline within, because a lot of these are old. They're just legacy assets coming, some of them coming to the end of their useful economic lives, and also in terms of reserves. So there's definitely a need for some new LNG projects within Africa. And Africa's well positioned geographically because obviously they can export it very quickly to the highest price market. And you can see that if you look at this black line and the green line. This is exports to Europe from Africa of LNG and exports to Asia of LNG from Africa. And you can see that over the last 2 years, they've started increasing their exports into Asia for that price. They see the high price, they're not silly, and off they go. And they reduce, they're taking it out of Europe. So those natural trends are actually happening, and it just matches when on this chart you take the Japanese, the blue line is the Japanese LNG price minus the UK price. You see it going up here in the last 2 years, and you can see that exports as a percentage of total to Asia jumping up to 40–50%. So they're taking full advantage of the prices available, and that's what everyone else is trying to do as well. The next question is, it's okay if you've got nice market dynamics and nice prices, but does it make sense? What about the costs of developing if we look at East Africa? So the Mozambique project, as you may know, is a monster. They are talking about 10 what's called LNG trains of 5 million tons per annum, so 50 million tons of LNG output. You know, the world produces 250 today, so this is really a very sizable project. And you can go through assumptions on CapEx and OpEx and royalties, and you can end up with what looks like to be very attractive returns. So a company would be well placed to go off and sanction such projects, which is why you're seeing Eni and Anadarko come together in November, December to start talking about front-end engineering and design for Mozambique. So on paper, it all makes a lot of sense. Before we get too carried away, though, it's just important to stack that up against the global set of LNG projects being developed today. Does Mozambique may look good on paper, but how does it compare internationally? And that's what we do here, and build up what's called a cost curve of LNG projects globally, and then find out where Mozambique fits within that. Clearly, you know, prices could suffer. You can never assume LNG prices don't collapse. If they do, you always want to be the lowest cost producer, naturally. Hence, you'd want to be down here. Mozambique doesn't fit here, which is a slight negative, but it's not up at the top end of the cost curve. You know, we have Russia, some of the Australian projects, Alaska LNG, some of the floating LNG projects, and back into Australia. These are much, much higher cost LNG projects. If prices were to collapse, these would be the projects that would suffer almost immediately. Mozambique would be relatively protected under that type of scenario. But again, highlighting just how good all the projects on the left-hand side, the low end of this cost curve, are all in North America. So again, it's just and this is all in the last 5 years. Or if we were sitting here 5 years ago, that wouldn't be there. This is all new. So fundamentally changing the outlook of this whole story. So another kink in the story is, it may look good on paper, but unfortunately this industry's not very good at handling costs. And everyone's aware of it. And if we just look at Australia, recently, the last 5, 6, 7 years, everybody trying to bring on a whole range of LNG export projects, you know, competing for labor and steel and equipment. And what happens is that so this is a chart of the increase in budget costs relative to the kind of early budgets, and just showing that on time here. How many months did it take until we saw very sizable increases in CapEx estimates for all of these LNG projects? And I mean, you can see the scale of this, 15% up to 40, 50% increases in CapEx. And that's a killer. That destroys the economics of these projects, and that's what dampens investor enthusiasm for them, and ultimately tarnishes companies and reputations as well. And within this, I mean, I'm talking about small companies, maybe like Santos here in the Gladstone LNG project, but equally Papua New Guinea LNG with ExxonMobil, or, you know, or Chevron here with Gorgon. It doesn't matter if you're big or small, you still aren't able to deflect from the industry cost pressures. But, you know, it doesn't matter who you are. So this is the biggest risk. That return on the last project was, we're talking about 20% returns. That's pretty healthy versus a bank account today. Or remember, this industry makes 10% returns. So this is double, and it looks very, very attractive. But if you increase your CapEx 30, 40%, that 23% will very swiftly go back down to 10%. And you end up with just a bog standard normal project that's people just aren't going to get excited about. So this is one of the biggest risks to LNG projects. Very capital intensive, and the risks are real. The other thing is just, and David mentioned it, about timing. How soon can we expect African LNG to come out? You know, if we were 10 years ago, maybe you could think about 3-4 years. But if you just plot a whole range of recent LNG projects from the time of final investment decision to LNG exports volumes, you can see the trend is just slowly ticking upwards here to, more recently in the Middle East and Norway and parts of Australia, 6-7 years from final investment decision. So even if Mozambique was to final investment decision this year, you probably have to add 7 years to that, and you should be really thinking about the next decade, not the 2018 that they're kind of targeting today. So I think that's another kind of kink in, or at least enthusiasm should be dampened somewhat, even though it all stacks up to actually be attractive. And it's also useful just to look at Nigeria on the other side of the continent. I remember I said Mozambique, the first project in East Africa, was 50 million tons of potential. Nigeria is 25 million tons, and it does build up in a staggered sequence, but it did take 12 years to get 25 million tons of LNG to be exported from that country. So again, it's a useful analog, just thinking about tempering the expectations here of a multitude of gas coming out. So, you know, putting all that together then, you know, if there was a lot of North American gas coming out, a lot of East African gas coming out, you could end up with a very soft patch within this LNG market. You know, so therefore we don't put in a lot of Mozambique, East African gas into this time period to 2020. We do put in a lot of the North American exports, and we will end up in a period in 2017-18 when the market will become a bit soft again, and companies looking to sanction LNG projects will have to be cognizant of this and really think, is this a temporary blip as it was in 2009-10? Are we comfortable enough to think this and sanction the projects? If the US was to export a lot more, that could stay here, and that's the difficulty in launching these 30, 40, 50 billion dollar projects. But in conclusion then, just to kind of go through some of those points again, we do think the markets are very attractive for LNG. Everyone's trying to get stranded gas out into this particular LNG market. East African gas, as we see it, is large scale, it's low cost, very well positioned to move into the LNG market. But the time periods need to be just better assessed. I don't think 5 years is appropriate, and I think we should be thinking about after 2020 for first East African LNG to come out. And then, but the thing that will happen, the more projects in a region, and David mentioned all the companies who are active there, everyone's looking for gas, the more companies there are, the higher this cost inflation risk becomes. We've seen it in Alberta with the oil sands. We've just seen it again in Australia with the LNG. It could happen in East Africa as well. And then the final thing is just, as I mentioned, we need to watch the US. If the US was to export a lot more gas, then unfortunately it would put pressure on the space in the market for LNG exports as well. But overall, I think it is a great opportunity, and the market dynamics are quite attractive for East African gas. And with that, I'm going to leave it there and see if you have any questions.
Okay, any questions from anybody? Yeah, please, Adam, right in the front here.
Hi Oswald, Jeff Boyd, I'm an independent field development consultant. I was interested, you pointed out with the cost of LNG going into Japan is very high, and presumably that, I think you pointed out that's because they're historically tied to the oil price. Now, is that going to change now? And if it does change, surely LNG prices are all going to head south, you know, internationally.
Yeah, that's a very big question, and we're coming through that in Europe, to be honest, because you had the European utilities are asking for lower prices because the UK price is lower than the European oil link price, and the US price is even lower. So the European utilities are asking Norway and Russia for much lower prices in these long-term oil link contracts linked to oil. And if I think about the last 4 years, that's been heavily negotiated between buyer and seller. And if 100% of the gas was sold at oil prices, through this whole period of renegotiation, we're talking about 10–20% of the volumes were repriced off a lower gas price. So it's just an illustrative point to say, even with all this negotiation, how much do these buyers really want to take off this lower price? And I think it was a small, for me that was a small number. It wasn't a big dramatic change to the industry pricing mechanism, which has been around for a long period of time. In Japan, in Asia, you're right, Japanese customers are not silly, and obviously they see the US price and they will want to access as much of that as possible. And they're currently negotiating for it. But I think one thing to remember is the current contracts do run out to 2025, if not to 2030. Those are legal contracts. Japanese, as you know, are pretty good at living up to their contracts. We expect that to happen. So I think from our talking about the next 15 years, we don't see your issue as a real risk. Beyond that, absolutely. But then it depends how much US gas comes out as well, because if it's, you know, 5–6 BCF a day on a 60 BCF per day market, it's not a big chunk available at that lower price for Asian customers. So there's a few moving parts, but I don't think it's a real something we really need to incorporate or talk about as much in certainly this decade, just because those contracts are still in existence. Yeah.
Okay, Adam, down here.
Robert Clues, SMBC Europe. On your cost curve for the different areas, how have you accounted for liquids production along with the gas? Because for the Qatari projects, the condensate production, the condensate revenues are a huge driver for those projects. And I'm just wondering how that works in East Africa, whether there is going to be a similar driver.
Yeah, of course this is just new projects, and this is primarily shale, so it's mostly dry, and you know, as you know, Mozambique so far, it's all dry.
Right.
I mean, they're clearly looking for condensates, and people are still looking for oil and wet gas, but at the moment it's very dry gas. So you're right, that's not in that number. But the Mozambique project, at the moment, doesn't have a material liquids component to replicate Qatar.
Adam, there was another over there.
My name is Sean Akinwale from TGS. I just wondering, what are your thoughts on the future of domestic African consumption?
I think I'm more constructive on the internal oil demand than I am for natural gas demand in terms of Africa. And I think one of the things we are noticing is, even countries like Angola specifically, a lot of the exports are dropping, and it seems to be going internally. So we see that sporadically across Africa, much more on the oil side. We're not seeing sudden drops in natural gas exports because of pent-up internal gas demand. Egypt has dropped, a few reservoir issues. Egypt is a domestic growth story for natural gas. That's the one example where I'd say it is a bit of internal demand, but on the rest of Africa, I'm not seeing anything that says suddenly it's doing this in terms of gas, but oil, yes.
Thank you.
Okay, anybody else? Let me just ask you a question about the US. I mean, how the hell are they going to make a decision about whether they're going to allow the export of 30 or 40 or 50 or 60? I mean, is this Obama sits in his office and makes a decision, or is it just lobbying by, how are they going to make that?
Well, what I love looking at is a little website called opensecrets.org, and it calculates the lobbying spend by every industry in the US, and normally the oil industry used to throw millions of dollars every year into Washington, and if you look at that website in the last 2 years, it's the chemical industry's just done this, so they're spending a lot more, and clearly they want to keep it to create ethylene off $4 an MCF gas prices. So it's a tough. It's all about who's lobbying hardest, which senators are involved. But they are doing investigations, and they've completed one at the moment to say what would be the impact on gas price from different proportions of gas being exported. So they're collecting all the information, but ultimately it will come down to Obama in his office making some decisions this year.
Yeah. I mean, do you think, one of the things you've told us is happening anyway before, but a most likely decision is to keep a lot of gas at home and let them export coal, which is they're doing at the moment, much more than they ever used to, and it's coming to Europe, isn't it? So
yeah.
You have these two anomalous graphs that actually European gas use is sort of doing this, and our coal use is, and it's coming from the US.
Yeah,
it's amazing.
That's what we.
So the answer to the question is the US exporting its shale gas yet? The answer is yes, in the form of coal.
Yeah. No, absolutely.
Really. Yeah. Okay, good. Anybody else?